You know, days like today is when I can call a lot of my clients that are in these fixed indexed annuities, and they will be happy and invite me over for dinner because of where they are. They're not taking a beating today, right? They're just a spectator at this point, and they don't have to worry about the loss. They're going to go to sleep tonight with their head on their pillow and have sweet dreams of what vacation they're going on next, you know, and that's how our clients should be. So, I mean, you've said a lot about the return, the rates of return. You've said a lot about, you know, what happened today with the market. Let's tell some people, you know, the pros and cons of some of these products. You know, the first thing is you're not exposed, right? So you're not at risk of any kind of market loss, while you can utilize the powering of the index and the crediting options that are available through these different indexes. Like right now, on a day like today, you're safe and you're not sliding backwards. Talk a little bit about these products, the pros, the cons, some of the features. Let's go into that.
Yeah, when you talk about pros and cons of the indexed annuities, you know, you're definitely, to your point, what's happening today is having an impact on those that are not involved in something like this. If they're exposed to the markets right now, they're feeling the pressure of what's happening today. But again, they're going to hear things. You're in this for the long haul. You know, we've talked about that a little bit. But when you have a product like an indexed annuity, a con can be and is when the markets really start to spike upwards, you may not get the full advantage of what the return of the market's really doing, because there are potentially, depending on product, this is where you have to have open dialogue and open conversation on products. There are caps potentially on what you can make from a month to month or year to year with these types of products. There's different things that can be a con for sure. Another con can definitely be, you know, there's surrender periods built into these products, depending on how long of that surrender period based on that product. Could be 3 years, 5 years, 7 years, 10 years. I've seen some as high as 15 years. So that surrender period, whatever that term is, that dwindles and goes down each year of ownership. But that is a con, because if you decide to withdraw and take the money out and surrender the policy, the indexed annuity, there's going to be a surrender percentage, surrender rate that comes out against that money. So you can lose money if you decide to say, I'm done with this, I'm moving on, and you're still within that surrender period. That's definitely a con as well. Kind of in the middle, kind of an in between. And what I mean by that is 401ks. I'm going to correlate this to a 401k just for discussion purposes. You have 401k and an indexed annuity. You know, people say, well, an annuity, you don't have availability and access of your money. Well, you don't in a 401k either, unless you want to take a penalty and pay tax, because that's how that works. If you're under the age of 59 and a half, you're going to be hit with a penalty if you take money out in a 401k, and you're going to be taxed because that's a deferred plan. If you have a policy, an indexed annuity that is qualified money as well, like a 401k, the same rules apply. You can't change the face of qualified money. So that works hand in hand. They're the same. The pros are something along the lines of what you mentioned. In today's and what's happening today, you have clients that are looking at this and kind of smiling and saying, I'm flatlining. I'm getting a zero. Well, that's much, much better and much more comforting for most people than saying I'm taking a 10% loss today. They can, what to your point, I can sleep at night and put my head on the pillow. So a pro is basically saying, hey, I'm hedging against any loss that can occur. So that's definitely a pro in terms of we don't have to worry about loss going forward. Now, but you're participating in gains, but depending on product, there can be a spread, there can be caps, there's participation rates. Those are all variables that we have to look at from our standpoint when we're talking to individuals of what we want to allocate and how we want to participate and what product makes the most sense. So when you're looking at those kind of things, we might not make as much when the grass is tall, so to speak, when the markets are really pumping, but we don't have to worry about losing 5, 10%, 20%, and then trying to recover and then start back over with our our accumulation phase and period to try to gain on that money going forward. So I think it's really the cons are, to kind of surmise a little bit, the cons are you have your money is potentially locked up for X amount of years, depending on the surrender time frame that you're in. You don't necessarily have access to your money, just like in a 401k, because of the rules that are there, depending on how the money's qualified or non-qualified. And then some pros can be you're hedging against loss. You can still have gains, but you still have to kind of go another step further. You still have a free withdrawal option within these plans that gives you access to some of your money, not all of it, without incurring a surrender charge. So you can take some money out, typically up to about 10% of your initial deposit, but you can still take some money out without penalty. Now, if it's qualified, you still have to pay tax, but if it's non-qualified, you might have to pay tax too, because they kind of flip the script a little bit. And what I mean by that is you have an economic term called last in, first out. So the way those plans work is the money that comes in there last, which is typically any profit, any gains, are going to be the first to be withdrawn. So if you do take a free withdrawal option, you're probably still going to have to pay some income tax, even if it's non-qualified money. So that there's some pros and cons to those scenarios as well, depending on what type of money you're trying to save, qualified versus non-qualified.
Yeah, and when we talk about the con of